for another week. So tonight we have a topic that has been bantered around a bit, and I know that a number of people, myself included, may not fully understand it or may not understand it at all. But the topic is called the big flip or an unwind. And Anthony has been so kind to talk about it tonight, but he also has put a document about the big flip in our education channel. Is that right, Anthony? It's an education?
No, I put in the wisdom channel.
In the wisdom channel, okay. So it's in the wisdom channel, which is right underneath of trading. And you can open that up or print it as I did, whatever you need to do. But feel free to interject with questions. I see Rogue's on, but he's managed to deafen his headset, so he has no idea that we're actually doing this. So I'm going to send him a text and tell him that we actually started. And Anthony, I will let you take it away, and we'll facilitate conversation as necessary.
Perfect. So the new trend, it's not really a trend, but it was made by like Carlo Cassio on Twitter. And I've kind of like picked up on it. I mentioned like end of December. There was a ton of consensus trades like coming into 2023, and that was short the dollar, long euro, short vol, long gold and silver, inflation to 2% by June, peak Fed rate, so expecting like a pivot pause. Um, long emerging markets. Honestly, it's all kind of like surrounded by the dollar. So I mean, dollar goes up, euro goes down, gold, silver go down, emerging markets go down, etc. So that's kind of why I said it's essentially kind of an unwind of all those trades, and it's all kind of correlated to the dollar. And obviously, like peak Fed hawkishness. Obviously, I mean, Powell's been dovish. He like failed to acknowledge like financial conditions loosening, which is kind of like with the economy strong, like unemployment at 3.4%, consumer spending up. There was like one backlash of it, which I kind of like questioned it for a minute, but it was like December. It was the manufacturing orders, and it came in like super low, and it showed like economic decline. But from what it seemed, because I've looked at like the past data too, that was just like a one hit wonder for now. And then what really like started, I feel like, to see this trend begin was last Friday on NFP was those the huge numbers because everyone was positioned for like recession, slowing economy, Fed pause, pivot, and it kind of like all revolves around that narrative of like recession comes in like Q1, inflation's dead due to demand being dead. So it kind of all revolves around that. But I mean, right now, I mean it's a strong economy as of now, even though layoffs that really won't hit. In my opinion, maybe till like I mean end of Q1, maybe Q2 is probably when you see. I've always said it's going to be like second half of 2023 is kind of like the economic meltdown, but like Q1, Q2, I feel like it won't be too bad. Just given like the trends and data we've seen. Um, but I mean, essentially, inflation will like reemerge due to financial conditions loosening and undoing the Fed's work. But we've seen that sort of reverse with rates and with yields turning up. I mean, 10 years up from like 3.3 to 3.7 in like the matter of like a week and a half. So we've already seen an unwind in that. Um, Housing, auto. I posted some charts in the Discord a couple like a week ago, or actually a few days ago, of the car index. It's been trending up. It like bottomed in December, and it's so that's been trending up. And then the Fed. I've kind of been going off the Fed because I couldn't really find any data or charts regarding housing. Um, But I know with rates down in January, there was like a surge of demand in housing, and so that's just all inflationary, like consumer spending, whatever. Prices going up. Tight labor market. That's obviously just demand. There's still like demand for everything. So, and then obviously China reopening, which was kind of like the one hit because never no one really like knew when China was supposed to reopen. Everyone thought like spring or March was kind of the consensus. So that kind of just added inflationary like pressures onto everything. And then I mentioned it earlier, but I'll reiterate. So coming into 2023, so the whole like expectation for inflation, I think it's like 2.5% for June, which I think is ridiculous. I think there's no chance that happens. And it was two rate cuts, and then kind of like I've been talking about it like past 2 weeks too was like I expected like the ECB to kind of like take back their word and essentially like they're gonna have to like pivot, like they can't keep going and keep up with the US. And then we already saw that with the Bank of England. I there was a quote today I saw it but they essentially said like we need to like retrack our steps and they started to like reevaluate hiking and because obviously their economy is like I think their GDP is like negative like 1% or something and like they're just heading into like a downward spiral from everyone I've talked to and people can't afford to live there so that obviously puts like pressure on the pound, pressure on the euro, and then you see the dollar go up and then given that's like a consensus trade you're seeing all three of those positions unwind. It's all called what was priced into 2023. It's essentially just called like the Goldilocks because it's like nothing can possibly go wrong for the setup in 2023 for equities to be reasonably priced at like 4,200, which was like I still think it's ridiculous that we're even up here, but that's kind of like why we're up here is because everything was priced in to like perfection. Um, But oh, so an example of kind of like where have we seen like unwinding of positioning and like how like quickly has it happened or whatever. So coming into 2023, CTAs were net short tech, and since in January, the Nasdaq's up 13%. So I mean that's just it was a month, and then you see all that short covering, etc. So that was kind of like the unwinding of that positioning. But this time, due to the narrative of the economy, we're heading into a recession, inflation's dead, and then the Fed is going to pivot, pause, and lack of demand, whatever, consumer spending, all that. So now you have the unwinding of like 12 different positionings 12 different positions, which is like I said it earlier, but short dollar, like long euro, short vol, long gold, silver. Inflation is dead. Soft landing, long emerging markets, and then long treasuries. So then all that has to get unwound, and then basically you just see yield surge, which we've already seen. I mean, 3.3 to 3.7. The 2 years breaking out. Dixie looks like it bottomed. It's at like 103.5, and I mean gold and silver breaking down. So the trade has already kind of started, and I feel like as the data just keeps on coming, that like economy strong, whatever, and then obviously for CPI next. I'm not sure what day it is. It's like Tuesday or Wednesday or Thursday, something like that. I'm not really sure if it's going to come in hot or not. I know consensus is like 6.2, and my buddy who's been like dead on is like doing a bunch of like analysis and whatever on it. So I'll send that when I get it. Um, but I'm not sure if the prices that happened in December will be reflective in this report. I don't think it will. It might be, although like gas bottomed in December and it's up like 20% since, So I'm assuming that'll play into the CPI. But housing and auto bottomed in December too. So I really don't know why the CPI wouldn't come in hot unless it's just like some one-off report where since it's like the new report where things have changed, whatever. But no, but I obviously expect inflation to resurge and like I retweeted it earlier. Hold on. It was the Adobe CEO and Adobe e-commerce price index, and it shows like everything is up in January, huge, and like a big seasonal bump. Um, so that kind of just adds on to that everyone's offsides and the fact that inflation will be 2% by June and economy slowing, etc. So it's kind of just all like a revolving circle, and then it honestly just all has to get unwound, which kind of just puts pressure on a bunch of different trades, and CTAs need to flip their positioning, and so that's kind of like a summary or kind of like some thoughts about it. So,
So, Anthony, who do you think gets fucked the hardest on this?
um, honestly, I'd probably say 80% of people were positioned 2023 like for like the opposite of this trade. So like everyone, I feel like everyone was like long treasuries. I mean, the dollar was like one of the top hedge fund shorts consensus everywhere. Like it was posted everywhere. Long euro because everyone's assumed that ECB, like the economy would be fine in Europe, so the ECB could continue hiking and then keeping pace with the US. And then long gold and silver, that's everyone expects like a pivot or a pause, which is why gold and silver kind of just took off. Um, and that kind of like front ran that narrative. And then everyone who thought like inflation was dead, soft landing. I mean, that's like a huge consensus everywhere. Um, no, but CTAs is kind of like though all those CTAs have to unwind their positioning, so they're getting bent over hard. Just like they were like I said, I mentioned earlier, they came into January short the Nasdaq. I mean, and the Nasdaq's up like 13% in January, so they got completely screwed. And then so you'll see like all that positioning like flip and unwind as the data continues to like eat at that narrative. If that makes sense.
And do you think that they've made much of an adjustment on their positions at this point, or do they
I
remain pretty naive about what's really going on?
I saw a CTA chart the other day. They're still like long euro, short the dollar. They did take out, actually, I think they added to their gold position. And then silver, I'm not sure about silver. And then they are short treasuries, so they have that trade right. Um, that was like a huge consensus trade. So I guess maybe I don't know what that trade was, to be honest. It could have been like that was kind of like the weird thing how CTAs were positioned for that, and that was like a huge consensus short at like when yields were like 3.3%. So
I
that was
would that's considered really much of a hedge given the breadth of their positions.
yeah, that's what didn't really make sense to me. Like I don't know why you'd be short treasuries and then short Dixie long euro because it kind of like it doesn't really like add into your thesis at all. So that was pretty weird. But
Well,
no,
my
no,
my can you hear me? I don't know if my thing's
yeah,
on,
yeah,
but
yeah, yeah,
so
yeah.
my understanding of CTAs, and there's probably others on here. I'm driving, so I don't know exactly who's on, but there's probably others who have a better understanding of CTAs than I do. But my understanding is that there's really no prognostication about CTAs. It's
Yeah,
merely a technical thing.
yeah, it's
They're not really doing a macro based trade. They're a fundamental based trade. It's solely a technical based trade. And so I'm sure there is something that and you might be very right. Where it's might just very well be a hedge for their other ones.
Yeah. Yeah, like you said, yeah, they're basically just like trend traders. So like whichever way the trend's going, they're kind of just hop onto that trend. But it always feels like they're just late to the trend because I know they like up their long exposure at like uh, it was like 407 ES, 4074 ES, something like that. So
I
that's when
think I think
I think
someone
it's
once
something like
told
that.
me, someone once told me on, and I can't remember who, to be completely honest, but it, especially on indexes, it's
Yeah,
usually something really, really simple, like
yeah,
over the 100-day or under the 50-day or over the 200-day, they're long, under they're short, something very,
yeah,
very simple.
yeah,
And I
yeah,
think you're dead on where, if we do start getting some momentum, this trade possibly can become essentially a self-fulfilling prophecy,
yeah,
where
exactly.
now it's like, okay, one thing starts to unwind, and then that's where sort of other things start to follow on a technical level, and that's what sort of triggers those types of CTA long versus short movements, which goes against exactly what everyone is long or short at the moment, right?
Yeah, yeah, exactly. Yeah, pretty much. Yeah. Yeah, so it's basically like a just complete trend flip because it's just what like the data says. It's just following everyone kind of had all the data wrong coming into 2023. Like everyone thought super down January, recession trade is on because TNX was at like 3.3%, which is like ridiculous considering I mean it was pricing like I mentioned like 2% inflation, all that. So everyone kind of just had that narrative and positioning like pinned. So then now that like data's changed, you have to see everything kind of unwind, and it kind of just yeah, like a self-fulfilling prophecy, and it just all they cover their shorts, whatever, change, switch their longs, etc., and it kind of just fulfills itself.
I've been thinking about this for some time coming up to this voice channel meeting. And it occurs to me, between the soft landing conversation that everybody continues to have, and it seems like this is moving a lot slower toward the correction that I agree with you has to come at some point, and I thought it would be sooner and more violent, which is what I think you're kind of pointing at too. It appears to me recently, though, that we're more or less correcting one sector at a time. So it isn't as if everything is getting beat to death all at once. It seems
Yeah,
like everybody's taking their turn in the barrel, and we just may be able to achieve a soft landing just through stupid, dumb luck.
yeah. I think, I think if you, I think for the people that believe like a soft landing, I think you have to think about if like the economy can survive in higher for longer rates, which I mean, for now it has, because obviously, like, I mean, unemployment's crazy low, demand's, the inflation's resurging, etc. So, but as the Fed continues to like be hawkish and another big thing about this, to be honest, so the whole debt ceiling issue, I was listening to like a Spaces with Mike Taylor. I've mentioned him in here before. But Yellen, I mean, I'm sure some of you know, like she's the one that like pumped all the liquidity into the markets, which is partly the reason this market has been so strong because it's just so much liquidity because of her. And apparently, like in October when the market was just down super bad, etc., banks like needed liquidity, which is why we saw like the Fed discount window get hit in November, and I thought it had to do with like Silvergate, SI, because they're allowed to tap the discount, um, and but apparently like Markets for Mayhem. I don't know if you guys follow him on Twitter, but he's some like big account. I was speaking to him about it, and he's gonna like post something probably like tonight or sometime this week. But apparently, like a bunch of banks need liquidity, to like sell assets or offload stuff, and they couldn't do that at 2,500 because rates were at like 4.3%, and there was just market was just stupid illiquid. That's when we saw that like 200-point reversal in one day from 3,500 to 3,700 in one day. So apparently those banks though, they're offloading their assets to regional banks. So apparently regional banks are gonna get whacked, and then apparently like in second half of 2023, some of those banks will like default, and then it's just gonna be like a whole downward spiral with that. But I mean, part of the reason I think, yeah, like I mentioned, the market's been so strong is the whole debt ceiling issue. So I feel like that's kind of plays a role into this trade too, or just like the market in general. So obviously, if there's more liquidity, I mean, it's self-explanatory. So that's why the yields topped like the day that Yellen started doing this. So it was clearly her, and then I mean it all adds up. So that's kind of like my take with like yields, and another like additive that I feel like not many people like think about that. That's why the market's been how it is.
And something that I believe John said, it was either last week or 2 weeks ago, and it's actually stuck with me a lot because it's something I actually never ever thought about. The market doesn't move on people being right; it moves on them being wrong.
Yeah.
And I think that I was actually going to bring up the mayhem thing because essentially what he's saying, and I don't know if he's posted it yet, but he put out a newsletter to his subs essentially saying, and take it for a grain of salt, mayhem is on the very, very far bearish scale.
100%.
And he's great. He knows exactly what he's talking about. The guy is probably eating 500 milligrams of Adderall an hour. That's how fast he talks. He's all over the place. But he's brilliant. But what he essentially is saying is that, one of the things that he believes that ignited this squeeze and why Jay Powell has been soft in tone, quite frankly, is because of this potentially banks already had a liquidity event, and something in that banking system has broken already or is in the process of, and so he's being very careful about what he says for that reason. And, the markets may or may not know that, and so they're sort of front-running this, right? He's talking very soft, and essentially saying, we're not mission accomplished, but we're on our way to mission accomplished. And I think that one of the things that is going to be very interesting how it plays out, and I don't know how it plays out. I'm divided whether or not I think the soft landing is possible, but I think something that's going to be very interesting to play out is what happens if it is possible. And I think that for some reason, I still feel like I'm seeing people discounting it being possible. And I'm sort of just taking the other end of the side that you're presenting here for conversation's sake, is what if it is possible? What are going to be our indications? And deep in my heart, I don't believe it is. But what are going to be the indications that we get as traders or investors that maybe this is possible, and maybe things aren't going to get as bad as. And so, what would be our indications that this trade that we're discussing, and I think a lot of us believe in, doesn't work?
Hold on, let me pull up.
It'd be Dixie dipping.
Dead cat bouncing dollar, right?
Yeah.
This asset's will continue going up.
Yeah, because I just wanted to read this. Since 1914, the Dow has gained 46.8% on average from its midterm election year low to its subsequent high in the following pre-election year. So, the third year of presidency does seem to play a political role in the stock market, in my opinion, based off that stat.
Does anyone have the Stock Traders Almanac in front of them and can pull up that stat that's on this week's page in there?
Bro, Aaron, I literally just read you the stat from
Oh, that was
have it
it?
in front of me.
Okay, I read it yesterday.
February. Yeah, only pre-presidential election years, only one loser in 84 years.
That was the stat I was talking about.
Yeah.
That's pretty remarkable, and I think that a couple of us were chatting earlier today about the obvious election year coming up and very likely manipulation, regardless of what your political leanings are, that they don't want this to get too good too fast, because if it does, it just can't keep going that good.
Yeah.
My only
I mean, I
concern is
think
that, oh, go for it, man.
I think a lot of it kind of concerns like the debt ceiling too, because like I mean, like if they're just pumping liquidity into the system, they're kind of like just undoing all their QT. There's like a stat somewhere I read it somewhere. But a lot of like the Fed's like quantitative tightening has been undone due to this. It's essentially like QE. Like that's what Yellen did, and that's kind of like what the market's just been crazy ever since. And then you've just seen a kind of like unwinding of like short covering positions. All the Goldman Sachs short funds have just been unwound completely, quant funds, etc. So that's kind of just added like fuel to it. But so I think like the debt ceiling plays a part in it. And then I think the soft landing also, I think if you're saying a soft landing, you also don't think inflation surges again, and you think the economy stays strong, and then you think the Fed will somehow manage to make all the right decisions, whether that's pivot pause, keep rates higher for longer, which I don't think will work because I think all these companies who just have a ton of debt are just going to freaking go under, default, whatever. I don't think they're going to make it. A ton of them won't. But that's kind of like, so the soft landing, like you need like a 2% inflation by whenever, even though the Fed acknowledged that that's probably not going to happen. So that kind of like shut down that narrative this week. And then the economy stays stronger, it doesn't really deteriorate, which has happened so far. So that's correct. And then, but like the whole big issue is like once the debt ceiling is resolved, all that liquidity is just unwound. And I post like a chart like every other day of like Fed liquidity, and like right now liquidity is sitting at like 3650 SPX. So I mean, if Yellen didn't really do what she did, I mean, I'm not saying we'd be at 3650 SPX, but I'm assuming we'd be at like maybe 3750, 3800, something like that, like a lot lower. So that's played like a huge role in kind of like giving the narrative that the market is so strong, or whatever. So
I mean, one of the things I had talked about with my advisor at Bank of America when we had a quick discussion just sort of about long-term investing, not trading per se. But one of the things he mentioned, and maybe I think this is a good topic of discussion too, is, the market is right now, it's underpricing, a typical recession earnings reduction, which is a typical earnings recession, but for a typical recession's earnings reduction, that was a tongue twister,
yeah,
it is 30%. And right now, the market is pricing 10% or less. So the question is when, and as options traders, that's always the big question for us, right? Is time a big key in our trades? When do we start these reports obviously are going to give us something, but these guidances are always going to be rainbows and butterflies and the world isn't crashing, So you can only take that with a grain of salt. So So I mean, I think the hard part here is finding the time when this stuff happens and sort of
Mm-hmm.
who it happens worse to. And I think this is a great trade to put on. How are you actually trading it?
So I mean, I've mentioned like I'm like short the euro, long dollar. I've been long VIX. I mean, I'm short like tech companies right now because like I mean rates are at whatever like 2.8%, and I think they're gonna go higher for longer, like that whole narrative. So it makes no sense in my opinion for tech companies to be up here. Um, that's kind of how I'm positioned. I'm not like positioned in gold and silver. I used to be long silver, and I was long GDX, but I feel like those are kind of like hard trades to like execute. So I've kind of just stayed away from that. What are the other consensus?
Is there anything that's weighted more than anything else?
Uh, I mean, long euro or short euro and long dollar is probably one of my bigger positions. Um, I'm still short like semis. I'm short like I mean Apple. I'm short like a few other tech companies like stuff like that. And just like a couple like like chart setups or whatever or flow or stuff like that. So that's kind of how. Oh, I'm short TLT. Um, so I'm short that stuff, but long vol. So that's kind of how I'm positioned in that it makes no sense for tech to be up here. And then if I think rates are going higher for longer, I'd obviously be short TLT. If I think we're going to see an unwinding of the dollar and all that positioning, as we'd see like short TLT and long dollar, I feel like it's like a pair trade because like if you're short TLT, you think rates are going higher or yields are going higher. And if you're long the dollar, that's like Fed hawkishness. So the dollar would go up. And then if you're short the euro, you think the ECB and BOE, Bank of England, they're all going to cave in, and they're just going to like they can't really. I posted like a graphic the other day, how like basically the structure of their economies can't really handle rates going crazy higher. And I've been paying like attention to the speeches, and she was like super hawkish, like a month ago, and this is when like the euro believed it, and she was saying we're just going to keep hiking. So basically saying exactly what the Fed was saying, and then now she backed off last couple of weeks, and maybe they're just saying they're just going to do 50, and then they'll be done. So if you think that, then the euro would go down because obviously, if they're just going to be satisfied with inflation at whatever it is over there, like 8% or whatever, they obviously think their economy is just going to whatever crush demand and it'll naturally like resolve, I guess. And then obviously, if you saw an inflation resurgence in America, you would see the Fed obviously they'd have to be hawkish. They can't just let that unwind and all their work undone, etc. So then you would see the dollar go up, yields go up, and then you'd obviously would see tech get crushed. Um, you would see all that get crushed. Uh, so that's kind of where I'm at.
And what
And then
time
like
frame
this,
for most of the options? You said what, 4 months, 6 months? I can't remember. Sorry.
I've I have a lot of like June and like July stuff. That's kind of like what my gold and euro positions are because like I feel like it's a pretty hard traded time, and
Yep.
like the options they're already cheap, so it's not like if you want to time it in April. It's I mean your percentage gains may be better, but like I'd rather just buy time on it considering like IV is like 10%, so it's not like you're like paying a premium. You might as well just
Yep.
pay whatever. And then I since we're at 4,200, I've been saying like I don't really see the upside of like going crazy buying here and stuff. So I'm kind of like positioned in like some April stuff, like some June and July stuff for like I have like June and July semi stuff just because they've just been freaking in a gamma squeeze, so it's kind of like hard to do that. But April stuff because I think I think we're close to like the market just going back in its downtrend. And then I posted in the room too. So CTAs have to sell 218 billion into a down tape that's already a liquid. So like when you see that selling pressure, that's I feel like we're gonna have like multiple like 100-point down days or some crazy selling where it's just days where they'll be in zero day trades all day and zero DTEs all day, and you'll just be market will just puke all day. So I feel like we're gonna have some days like that. Because CTA is them being like a forced seller when they were forced buyers pumping the market up. So then all that position unwinding, you kind of just, if that, you know what I mean, it just makes, so that's kind of where I'm at.
Well, thanks, Anthony. That's really interesting. I wanted to see if some of our old school Chicago guys had anything to add based on historical perspective that might be interesting. I mean, I know that we're kind of in an unprecedented place relative to the Fed's actions and just the alignment of data and what they're dealing with,
Mm-hmm.
especially relative to employment numbers, et cetera. But I wanted to see if maybe Neil or Rogue had anything to add. I don't see GD Rolls in here, and I don't know if Gov made it tonight.
Yeah, I
Neil,
mean, I can chime in for a second. I mean, pretty much to sum up in simple terms, people are offsides, right? And
Oh
if
yeah,
they're
yeah,
right, they have to take profits, right? So if you're long, you have to sell, and that makes the market turn around. So a lot of it could just be positional.
yeah.
I'm not sure if it's gonna like flip long term. It's gonna be kind of tricky with the Fed overall. The debt ceiling stuff is a bunch of noise. Like Yellen can print $1 trillion coin. So the idea that we're going to default it's impossible. Even if there's no agreement, whatever, she will mint a coin that will pay all the bills. So I always think that's more sensational, and it sounds like, oh, doom and gloom and kind of bear porn, but it's a complete non-event. They're probably gonna get it done right at the very end like they normally do, but it's if people are either wrong or it starts going against them or they have to take profit, that's going to make these sectors move where it's overloaded on one side positionally. People are in, they have to get out.
how would you play it, Neil?
I think what Anthony said is pretty much laid it out there. You kind of have your choice. You can go with the currency side, you can go with the metals side, the bonds, those really seem to be the plays. I'd probably prefer those over VIX, just because VIX is its own beast. It's not really a market; it's a derivative of a derivative of a market. So in that sense, there's a lot more dynamics to it, and but so I'd probably go with the bonds or the currency plays involved.
Okay, I appreciate that. Um,
But I
one,
think Anthony really laid it out very nicely as far
oh,
as
outstanding.
what the sectors were and so I don't really have much to add in that sense.
Yeah, no, I was more interested in your perspective in terms of maybe if you saw some correlations to the past and what you might have witnessed in your career.
Yeah, I mean, we're in uncharted territory. We've never had this much debt. We've never had this kind of economic situation. We've never been, raising rates with like this at this speed in this environment. So it's really difficult to come up with a parallel of what I've been through. I mean, we're all in uncharted territory here, kind of going through it together. But I
Well,
wish
I
something
think
else.
that many of us will agree that over the last year or so, that it really has been remarkably orderly in general, the market as a whole. I mean, for what we've been going through, and the way that the Fed has delayed their responsibility, so to speak, in not getting involved earlier and starting to get a hold on this thing, that I think that it just has been startlingly orderly in terms of a drop, and nothing has ever come across in the last year plus as panic.
Well, I think part of it is you have to separate the economy from the market. Okay, they're not the same. It's not really reflecting much. And if you look at it just based on the option dynamics, if people are buying puts, we get like a news event like we did, back in February with Russia. Now all of a sudden we move and we start to move down. We need that news. We need that push, because otherwise people are going to buy puts, right? Over time, what's going to happen? Theta, right? It's going to decay the deltas. So the people on the other side your market makers are going to start doing what? Covering their hedges. And when you buy puts, the market maker is short puts, which is a long position, right? So they're going to sell futures against it. So that means that as time goes on, they're going to buy their futures back. And it needs that kind of like spark to the powder keg to really start tumbling over, because that's kind of one of the barriers you face when you have puts, is if it goes your way and it goes your way quickly, all the Greeks are on your side. But if it's not going your way, then they start working against you. I don't know, does that make sense, or do I need to clarify that for anyone?
Makes sense to me.
You know,
So, based
ahead.
on what you're saying, Neil, obviously we always need catalysts to move things.
Hmm.
And of course, we've got another major catalyst coming up. I think it's on Tuesday this coming week with CPI. I would love to hear anybody chime in and maybe talk about what they are thinking in terms of our CPI print.
Well, real quick, like, I wouldn't consider CPI a catalyst. Okay, a catalyst is going to be more like a news event, something that's unexpected. CPI is going to be, are they positioned correctly or incorrectly? So when it comes in line, it's not that exciting, right? When
No,
the numbers are
it's not a
off,
catalyst when it's in line, but as we saw in December on the 11th, it can spike those candles like crazy.
exactly. That's because people are offsides. And it's the same principle as the big flip thesis, is that they're in a position, it's working for them, and it starts not being as good, or they start having to take profits, and that's what moves the market.
Yeah.
Think about rogues, it's people being wrong, right? So if they're positioned wrong, we get a real big candle right off of the CPI. But I have no idea which way it's going to go. I'll let someone else chime in that crunches data more than me. I'm more of a cowboy when it comes to that stuff than a statistician.
No, but to come off that, of like people being offsides, because that's kind of like all what it is. So like basically they're offsides if inflation isn't at 2% by June. They're offsides on that because that's kind of like how they're positioned. They're offsides if the Fed completely stops, or if the Fed keeps going higher for longer. So they're offsides on that perspective, and they're offsides if the economy stays strong, because that kind of just fuels inflation, because they're all positioned for a recession if they're all like long TLT or whatever. So that's kind of like the whole narrative. Like, so you'd see all those positions unwind, and we kind of like already saw that. Like last Friday was when we kind of like started seeing things shift. Gold was down like 5% in a day, so there was definitely like there had to be some closing out of positioning by like a CTA or whatever. CTAs with that, because that's a pretty big down day for that. And then yields obviously from like 3.3 to 3.7 and such from Feb 3rd to Feb, whatever today's date is, like the 11th or 10th. So, I mean, in such a short amount of time, you've already like seen some of it unwind from when we started talking about it. And then the dollar from like its low was like 100.8 and it's already at 103.3. So you've already seen some of that positioning unwind. Um, so that's just like adding on to him. But
So does that mean that maybe aside from currencies and metals, that a lot of it may already be a miss in terms of opportunity?
I don't think so. Just
No,
because,
if the next download starts, we're gonna have plenty of time to identify it.
yeah, yeah,
I wouldn't be rushing to put on bearish positions.
yeah. Because I posted a few times too. I mean, there's already, I mean, there's huge divergences between yields and bonds. Like the divergences are crazy. Uh, let me pull it up. Like, I mean, just looking at QQQ, if I look at the divergence of where it should be based on where yields are, it should be at 282, and right now it's at 301. And the gap always closes. It always has. So either TLT goes higher and then they meet with each other, or QQQ comes down lower. So that's how big of a correction is that? It's from where yields are now, like a 6% correction, or maybe a little bit. So I'm kind of like looking at that divergence, which is makes me just not want to touch anything long unless it's like a day trade. Um, so I'm looking at that, and obviously, if you think yields are going higher, the divergences are only going to get bigger. Because the 10 year is only at 3.7, and if the Fed is going to do whatever they say, 5% FFR, whatever, yield should be a lot higher. And then obviously, if that means that obviously means it should be a lot lower too, SPY and all that stuff. So that kind of plays a role into that, which is why I've kind of just positioned how I am, just because of these divergences. And then SPY is at 407 right now, and if it was in line with where TLT is, it would be like a 6%, like 5% correction, same thing. So SPY would be at 385 if they were in line with where yields were. So that's kind of like that divergence I've been like talking about too, and kind of like why I'm positioned how I am too. So
Has anybody else adjusted any of their positioning based on maybe not the whole premise of the big flip, but just feeling as though the Fed may not be as ahead of the curve as they portray themselves to be?
Personally, I was waiting till expiration, but Scoob did mention that it was in backwardation or something like that. I don't necessarily what that means. I was actually going to look into it.
Yeah. No, I agree with what you're saying, Leon. I think just based on GEM's forecast, usually what we see is after an event, we have expiration. you see a lot of supportive vol flows disappear, and that leads into kind of a leg down or market decline.
And,
We've seen that many times, and I think he even said, even if the CPI comes in line, could be a sell the news event. So all of those factors also make me cautious around that area.
and then I
But
think to
yeah,
add
what,
on,
what you're referring to is, we can talk about this later because it's a technical thing. But there are ways to compare the VIX futures curves against each other and see what vol is being bought up or is in demand, which indicates usually some risk off positioning or hedging.
Perfect.
then,
Yeah, nice.
and then I think to add on to that though, like what Scoob was saying about what VIX and all that, and like how it could like spark us off, like that's kind of like the window for it. And then you have to add on to that CTAs are going to be selling into that tape, and it's like 213 billion. So you kind of have to like keep that in the perspective that if we do sell, CTAs are sellers in that down tape. So in like that illiquid hole, so that's I'm keeping that in mind too. So
I mean, there's a mechanical reason why that time is vulnerable. If you think about it, we're going straight up, right?
yeah,
Have been. So people have been buying calls. It's kind of the opposite of what I was saying before. So dealers and market makers are short calls, right? Which is a short position. So they need to buy futures, right? What happens at expiration? They don't want their futures, so they have to dump it. So the higher we go and the more of a spike we get, the more vicious that decline is going to be. Because if they're going to stay neutral, then that means they have to either sell a whole bunch more calls, all right, which is what they need to keep that hedge on. But if people stop buying calls, then they have to start dumping. And that's where things get really fun. If we kind of spike up through OPEX somehow, I mean, obviously it's been pretty bearish and there's been some technical damage, and they could be just front running that effect right now. But that's one thing to watch out for is what's, when that expiration comes, they have to get out. They don't care. They just have to maintain their hedges. So that's really why that time of year, because of the seasonality where it's bullish that month coming into it at the beginning of the year, that's why it flips in that time.
Neil, in your experience, and I had to step out of the conversation for a second, but I don't know if Gov's on or I'm sure Rogue is on too, but in you guys' experience, so, we all look at these seasonality charts and whatnot. February, to me, is always one of those months that is an eyebrow raiser. Is there any time of the year there where you remember sort of more bigger players selling or buying than normal?
I mean, very beginning of the year, very end of the year.
Do you consider that February or just January?
I mean, December, January is always really busy, right? Because you're going to have your rollover, you're going to have your quadruple witching, you're going to have your end of the year stuff, you're going to have your tax loss, all that stuff comes in at the end of the year. And then the beginning of the year is when a lot of stuff goes in. Obviously, it takes a week or two for people to get back from vacation, but that's when things are busy. The summer is dead. That's usually when it's the lowest volume and the worst time of year. But as far as seasonality, I mean, there's nothing that I have to argue with in regards to what's in the almanacs or the traditional metrics of it. But, try and trade in the winter more than the summer in general, just because that's where the volume is.
And if I remember, I can't remember why it is, but February and someone with the almanac in front of them, it tends to be a pretty bearish month overall, compared to some others. I wonder why that is, if there's any actual reason for it.
I don't
I'm
got
not
the
sure.
in front of me, but I would think that it'd be the January effect, kind of just taking profits. I
Yeah,
did want to
possibly.
say something against the whole almanac thing and the picture I posted with the pre-presidential election years. I just started trading like in 2020, and when I first started, I heard a lot of commotion about Trump and how he would talk about the market. I don't really hear Biden talk about the stock market, so I don't know if he really cares or if there's a political reason to make it go up. I don't know if anyone with more experience, has remembered anything like this.
Yeah, Trump was kind of unprecedented. It's normally not mentioned as like a bragging point like it normally is, or as often as it was. It does come up, but I mean, it wasn't mentioned in the State of the Union at all, this week. So, there's really, I mean, Reagan talked about it a little bit, but it wasn't like Trump. That was like nothing we've seen before. Like the way Biden does it is more traditional, if you want like a historical measure.
Hey guys, this is JD from Maple Land. Can I ask a few questions?
Absolutely.
Two questions. One is JD or is GD Rolls a voice actor? He's got the voice of God on Discord.
He's not on air tonight.
So who was that with the deep voice? My
That's
goodness.
That's
Neil.
Neil.
That's Neil,
Oh,
and
Neil.
he is
Man.
God.
The
Neil, are
man
you?
with
He's not the
golden
voice
throat.
of God. He is God.
Yeah,
I
right.
love it. I love it, Neil. A quick question for you guys. So you guys have been following this Carl Icahn trade as well, right? With the big changes up until now, they've been buying the wings on the volatility, right? Like they've been bidding volatility up, and they've been buying, as far as I can see, the wing structures on like on the actual VIX side. So between now and CPI, we're going to expect some turbulence, right? Like if you look at the hedge structure, the market SPX will be hard to break the 4,000 level, I think anyways. But if it accelerates, then it'll be harder. Is anybody thinking that we maybe climb out of the CPI and that's what takes us to sort of like the next leg up? Is anybody with that thought process at all? If this volatility gets bid up before CPI, we get down to a level where there's a lot of support, and come CPI, like we're free to move around. Has anybody given any credence to that sort of a thought at all?
Well, I jump in
I
on
have
that. And I
100%
say that I think that Mancini has kind of been pushing that with his narrative in his newsletter for the last week or so, that he thinks that we're just going to chop here and build a base. But I would say that, everything that he's been talking about leads him to believe that we are on a trajectory upward to around 42,
Yeah,
68.
4250 to 4300.
I mean, my sort of thinking, and I try a lot more now and be more cognizant of it than I have in the past, to not make sort of prognostications sort of about price even a couple of weeks out. However, I do sort of remember these sort of weird patterns where, and especially over the last year and in other down markets that I've traded in, I'm sort of thinking of 2018 a little bit, and then sort of in the COVID stuff. And, one of the things that I find happens pretty often is, we'll have a big rally, and then, everyone says, okay, well, say like last week, or I can't remember when we hit 42.05, or I think it was, right, the high, and then we'll immediately sort of push back off of that, and we'll push back down 100 points, 150 points, And, people are very quick to say, well, that was it, and market doesn't tend to do that. It doesn't tend to pull off such a key level like 4,200 and say that's it. It tends to toy with you a little bit more, where it might push off 4,200, come back to, and I'm just throwing numbers out, 4,100, and then everyone sort of gets a little over the saddle and piling on the other side, and then it tends to sort of have one more last gasp up, and it could even be a new high. But I think it would be too easy to say, we come right off 42, and that was the short term top. I tend to believe that would just be too easy of a scenario.
Yeah. I mean, I think obviously there's a lot at play here, but yeah, just looking at even sort of DAX, Germany, where prints come in line, DAX does well for the most part. Like, to me, I just feel like there's this air of, oh, CPI is too high. Like, no offense to people who are taking a trade that way, but it's just one of those things where, I mean, if you want to talk about a volatility where everybody's going to be surprised, and I think CPI comes in way higher and the markets do take a thrashing. But I think 4,000, there's a lot of structured items there that I think would be hard to break. And unless you have some sort of big event that comes in, I think that 4,000 level is going to be a bit hard. But again, who knows?
You're right, and usually that's how those things go, right? And we've had this happen in a couple of events, whether it be longs or shorts. A level is sort of that's going to be really hard, or you hear people say that's going to be impossible to break. And what happens will be an 8:30 data release in a lower liquidity environment, even with people watching it, and that's what it takes to get us off and offsides and underneath. When the bell rings at 9:30, and that's what starts the sort of the dealer unwinds.
Yeah, I mean, Aaron, the only other thing we have to watch out for now is obviously this big Carl Icahn trade, right? Like, I mean, it's a $50 million trade, but you look at the notional value, like that is going to swing the markets when he actually does unwind that trade, whenever that is, right? Like, I just read High's thing on, he thinks he's going to cash out and short ES, which very well could be. But when that trade is unwound, I mean, it's another factor in the market now that we have to watch out for. Whether he keeps
that guy, Andy, whatever his name is, has a good write up on that trade today. It's worth a read.
About Carl Icahn's trade?
Yeah.
Okay.
All you need to know about the trade is Icahn is short and he's bearish.
Yeah.
It doesn't matter. He's not, someone like him isn't going to give a shit about a few ticks.
Yep.
He's not doing degen stuff. He really doesn't even trade that much. He's a corporate rater. He'll like go into companies and go through their books and find that they're undervalued and find shitty boards. Like he's like OG corporate rater.
Yeah.
So for him to get into the S&P means he really sees something.
Yeah,
Yep.
exactly.
So to me,
but keep in mind, it's a short-term trade. So when he does unwind, it is a pop to the markets, though. No?
I mean,
yeah, it is.
Depends when
how
he
much
unwinds.
of a pop. And what does he do?
I mean, he could take delivery of the futures. He doesn't.
Yeah,
have to.
that's the thing. And what about the other side of the trade? What about the dealers that took the trade? So I think a lot of it will happen slowly, right? The positions will change, the deltas will change, they'll adjust to it, and he'll probably end up taking the short position.
And wouldn't they mostly in a trade that size, and I assume from just looking at it yesterday, didn't he fill in 4 lots? I assume, and you probably would know better than I, don't they try and pair those off with someone on the other side of it?
I mean, they have to, right? Someone has to take the other side of the trade.
Yeah.
And that's where the dealers come in. They don't really care. They just want a little bit of juice. They're kind of like a casino, right? They set the line at
I think
negative
Aaron's
110 for both teams in a scratch, or, in a pick 'em, because they just want that little bit. And so they'll take the trade. They'll put on a futures position. Or maybe they have a position already, or they'll put it against a book. There could be someone that's like a book that needs to take a bearish position or a bullish position. So they'll take those puts.
Yeah.
But someone like Rogue would be better off, answering like how the desks will go and actually go and execute that trade. But sometimes we're looking at the details and we miss the big picture, which is Icon is bearish.
Yeah.
Yeah.
Good point.
Exactly.
If
This is Rogue.
go for it, Rogue.
Okay, good. I got my problem solved. So yeah, what you guys are talking about makes a great deal of sense. Just know that on a position of that size, that there's all kinds of other trades that are going on around that trade. Believe me, Icon's guys are managing the shit out of that trade. I guarantee you, it won't necessarily show up in the puts. I mean, very well. There's no question that there's futures being traded around that position too, banking it, and then letting it rally, and then cashing out the futures, and then letting it ride naked again. So there's a lot of timing. So it's not just one simple trade, especially something that large. And for a guy like Carl, it's a 50 million. That's a relatively large option position, but for him, it's not. It's not like an all-in type of bet. I mean, Carl is worth a boatload of money, so
It's the change in his couch.
yeah, exactly.
So I mean, saying I think you make a good point. It's not a whole lot of money to him, but I think the key here, and Neil mentioned this, is he's not a trader. And from my time sort of following the options markets, I can remember maybe 2-3 trades he takes a year. He always sells options. This is the first time I can remember that sort of it's come out and been known that he bought options, especially short dated. I guess the thing that is interesting to me here is why so short dated. Like, he's got all the money in the world. This is sort of couch droppings for him.
I have a simple answer for you, because he was probably long.
Oh, well, no, there's no question that in Carl Icon's portfolio that he's long a bunch of stuff, and so certainly he's hedging. There's no question about that. I mean, a guy the size of Carl, if he the things that he's long, he can't get out of them without being noticed. And it's a much easier transaction for him to hedge overall market exposure the way he did it, rather than in any regard necessarily being a directional. Now, understand that obviously, if you feel the need to hedge, you feel that there's a certain percentage chance that indeed the market is going to go down potentially sharply against you. So there's no question about it. But a lot of people are making a lot out of this without context of the fact that Icon owns a lot of stuff. A guy like him is certainly net long overall.
That's a great point, and you're absolutely right. It is completely overlooked, and even overlooked by me. You're dead on. Thank you.
Yeah. Now, if he'd come in and that had printed as he he did a whole series of options and had put $3 or $4 billion in it. That's a different type of vote, to say the least.
And now, John, I guess it sort of leads to the second part of my question. There is for a guy who traditionally is an option seller, right? He's and whether it's a hedge or not, right? He's selling calls or selling puts against the direction he believes that it's going to go as sort of like a cash flow trade. But why so short dated? If he's got all this long exposure, right? And I'm just thinking out loud. He's got all this long exposure, why a 7-day trade?
He may well have a bunch of unseen option exposure on the long side, on the call side, that's unseen simply because it's scattered across a whole bunch of names that he needed a hedge.
That's true. And it gets back to that thing we always say, you never know what's in someone else's book, right? And that's why flow is so difficult to me, is immediately I start thinking, well, what could they be hedging or what's in their book? And then I sort of see a shiny object and look elsewhere,
well,
like a raccoon.
That's a great point. And it's one of the problems I have with, flow trading, which of course now, is the thing. And the problem is that once everybody embraces something, it's not going to work. And the reason it's not going to work is precisely what you just said, and that is you don't know his whole book. And if you don't know his whole book, you can't get a read.
So is this a trade you get a read from, or you totally look elsewhere and go look at shiny things like I do?
Yeah, it's not to me. I don't trade on the basis of it. I mean, obviously, he had a good day today, and I guarantee you, they bank some of that, not necessarily by closing out the position, but through the futures markets, etc. Just understand that Carl himself, quote unquote, makes these moves just a few times a year, but he's got a very active desk that is massaging his positions constantly.
That's great insight. Thanks.
You're welcome.
Thanks, John.
John, do you have more questions about that? More comments?
I mean, really, the understand that trading is absolutely, an art of deception. So, I mean, literally, Icon could want something cheaper in real size on the equity side, and have thrown 50 mil out there just as bait to get his price.
What about you, Jonathan? You initiated this question. What do you think?
Yeah, no, thank you. I was sort of just trying to get the feel for what this I can't trade does for the markets, and I initially my thing is why such a short time period. That's what I keep going back to is you've got a $1.5 billion notional play out there, and you've got 7 days to massage that position. So that's where I was like, maybe there is a bigger impact to this than what I originally anticipated. And like I said, there's structures there enough that the markets can go down to 4,000 SPX no problem and still rise from there after that. So I don't know. It's just something to keep an eye on.
I think something that's very interesting here, and you brought up a really good point, is all the stuff down there. And so what happens if, let's say, and let's play doom and gloom for a second, let's say we do get below his strike, right? That obviously, what does that do for market impacts? Obviously, it's going to have some sort of impact, but now then you get into those structures 50 points below.
You're really overlooking one thing. Okay, he doesn't trade like we do. Okay, he wants
True.
to take
That's
the
a really
future.
good point.
In fact, he really doesn't trade.
Yeah,
He
like
has some exposure. Hey, maybe he had some information that some shitty news is going to come out and bomb the market for a short while. You know, that's why I just trade price, because basically every single element that we're discussing and trying to figure out here is reflected ultimately in price.
Mm-hmm.
but Icon doesn't have to close.
He
No,
doesn't.
True. Very
No.
true.
Like the market goes down, he makes a lot of money on his hedge, right? Or he closes out some of his longs. Say the market ripped to 4,300. Well, what does he care about what he paid on his hedge? Because you just made that much more on his futures.
He just made billions on the futures if it
So,
ripped to there, and so he doesn't care about 50 million.
so
Right.
you know, you have to look at it
It's
that,
less than a rounding error for Carl.
yeah, I mean, he did it for a reason, which means maybe there was a window of weakness, but it may not mean shit. We don't,
Yeah, you're right.
I don't trade flow either because I don't know what it is. Like, meaning if I see a big ticket, well, is it tied to something? Maybe. Is it tied to something existing? Well, I'd have to study that for years. Is this a roll? Is it a roll of a winning trade? Is it a roll of a losing trade? What's the pattern to identify these guys? Because I mean, if you're doing a 10,000 lot, how do you know?
See,
You know, there was
that's
certain
why
on the
that's
floor, like
exactly
there were
the point.
certain odd lots where we'd have an idea. Okay, it's a 638 lot. That's Goldman. You
Right.
know,
But
or if it's but
this
when
is
they're
why
talking round numbers, who knows?
this is why I trade only price, because price is closest to perfect information as there is.
Right. Yeah, okay, I will just say with flows, like obviously for the last who knows how many years, flow has buffered my portfolio in a bigger way. I will say, like, there is no perfect reading to flow, but there is momentum flow, and I think there is a differentiation between the two. And I think you can make a lot of money if you can get the momentum right. And like John said, it's the price. But like the perfect example is me, because I had to go into a meeting today. But that Google was breaking an area of confluence on the charts while there was flow that was hitting at the same time. To me, that's a flow that's worth taking. I'm not saying the structured trades behind things like Apple and Amazon are worth looking at, because there's a different thing there. There's things tied, there's stocks tied, there's crosses between MMs, there is employee stock options. There's so many things that are tied to it, right? But if you can look at momentum flow from a momentum perspective, there is a lot of power to it. From my perspective, anyways.
I'm not talking down flow in the sense that I mean, JD's the flow master, like literally, like
I'm not, though.
you
I'm
are.
not.
But in a lot of ways, like that kind of boils down to it. Like you either like get it or you don't. It's
Yeah.
you kind of have to have like a gift to do flow. It's hard to
I
really
just heard that
teach.
you use flow basically to confirm price, but price
Yes.
is primary.
Yes.
Mhm.
Absolutely.
I mean, the price is the price, and one of the things that I learned very early on in my career, and it's very beneficial to me, now as a screen trader, to have spent years in the pits, and that is there exactly what you're talking about. There's lots of things going on, and we don't know, and so in the pit, the only thing that matters is what's the bid and ask now, and you may know things that are in your deck that might have market impact, but still they're only going to be triggered at a price.
Mhm.
So price is primary, and uh, I guess the message that I would leave with you guys is that simply these are all elements of a market, but ultimately the price is the market. And I mean, for instance, again, I don't have to worry about hedging because I have an automatic program which, absolutely printed money today on the short side. So in effect, anything that I needed to hedge was already hedged, and I'm actually, making alpha off of the futures side. But all of these sophisticated operations, like a guy like Carl Icahn, they're doing that stuff too.
Mm-hmm. Yeah, John, I totally agree. Listen, first and foremost, price action dictates what you're trading, what you're looking at. Completely agree. Many times, what I will see sometimes on the level two, on L2, is that you'll see some guy smack down a price, and then a flow will come in right after, as let's say, as a put or whatever the case is, or the opposite. There's a support structure on the L2, and you'll see a call side come in. So to me, that's how you pair the two: is you can see the price action and you can see how they're working it through the flows as well. And that to me is a good trade. You know what I mean? Like Google this morning, I messed up, but I picked something up at 60 cents and it ended up at somewhere 260 because I could see to the L2 that they're smacking the price down. Like there was no bid. And you can use flow to see the structure behind it too. So again, that's what I'm saying. Like there's nothing special about it, but for momentum trading, you guys are trading bigger portfolios, bigger books, a different model. I'm trading a much smaller quantity, but how we can use all sorts of different tools to sort of paint a bigger picture.
Well, first of all, congratulations, because you got to know where you are. And that's really important, in the evolution and of a trader. But other than that, just whatever the new shiny thing is, that's which flow is now, simply because you've got all these services that publish it, and they're getting a feed out of the exchanges that any one of us could buy if we wanted to, and then they're just remarketing it. It's obviously doing good business right now, but ultimately the only thing that pays any of us is price. Now, I like what I'm hearing when you're saying you're looking at price action and then confirming it with an options action. And that's the confirmation is fine. Just make sure that the things that you're using as confirmation are also not crutches, in which you're talking yourself out of a trade. You're like, oh, this thing says I should be shorted, but I'm going to wait till I get some confirmation. I mean, if your primary indicator, whatever you follow, tells you to be short, put some on, and then put some more on if you get some confirming factors. But don't wait for it, because remember also, these are all ex post facto. They're all reported well after the fact.
Yeah, good point. Good point.
Well, anybody else have anything they want to chat about while we're all gathered in one place, so to speak? It's 7:24. Anthony, you have any thoughts that you'd like to just kind of wrap up with in terms of Big Flip and what you're going to be looking at tomorrow?
I think we have data tomorrow. I think it's NFP data like last Friday. I'm trying to see if someone else knows. I think we do. I feel like obviously if it's strong, it kind of would be the same thing as last Friday. Yield would go up, dollar would go up, etc. So I feel like it kind of just be like a repeat of last Friday. And then there's China CPI in an hour, 8:30.
Is
So,
there Anthony? Is there a Japan CPI, or did I just like imagine that?
that was Japan PPI, I think.
Oh, okay, cool.
Yes. So I
I mean,
know.
the China thing could really put a fight. I mean, if bad, I mean, if it's good and whatnot, and it could be a small lift, I think. But if bad tonight, I mean, we're in pretty pivotal spot for bulls to hold, in my opinion.
Yeah.
And a lot of times these overnight moves can really instigate these longer trending a couple of days, whether it be 5 days or 5 weeks. These overnight moves can really light a fire under that. So tonight's an interesting night for me.
I think China will be interesting too, just because they just reopened. So obviously demand should be going up. So I mean, you would think inflation would maybe go up too, considering, I mean, demand for services, et cetera. So I feel like that's kind of with us, like economy strong, so demand strong. So that's kind of how I see it. So it kind of could be similar. So be
Yeah,
interesting.
and that combined with sort of the technical areas we are of price on the index level, I
Yeah.
think is a very not necessarily a night I'll trade, but certainly a night I'm going to be keeping an eye on. That's for sure.
Yeah, I mean, if China's hot, I don't know why I mean, I could definitely see them front run us, and maybe we'd be down off that. So I could see that.
Exactly.
Totally.
If it's not, and it's something I'm not so sure it's an instigator for a rally. However,
Yeah, I agree.
it's
Yeah,
sort of one of those things where if it's bad, it could really sort of give us a little kick in the butt downwards. But if it's not, I'm not so sure it has a whole lot of up impact.
Are any of y'all looking at NVIDIA and AI unwinds over the next, tomorrow through next week?
yeah. I feel like there's got to be some unwind plays for tomorrow. All these freaking stocks that are just like gamma squeezed up, et cetera. So I feel like
You
there
know what,
should be some juicy stuff.
NVIDIA reminds me of Caterpillar and how much money I've lost in the last 2 months trying to short that fucking thing. That's really what it reminds me of. Is like this thing's just trending nicely, going up, and you're like, oh, it can't go up anymore. That was me with Caterpillar, and it just does. So, I mean, I'm very cautious about getting in front of a lot of these semiconductor names that have been quite strong.
Yeah, it feels like you're kind of stepping in front of a train on the momentum with these. And so we're about done here, guys. And I just saw the jackass Kramer on my muted CNBC, which I don't know if it ever has volume, but made me think of the lightning round from years and years ago before I knew anything. And so I just wonder, does anybody have any big names in mind? What's exciting that you're watching? Just toss out a ticker.
Just in terms of technicals, or in terms of
Something that excites you one way or the other, up or down.
Disney is exciting.
ES is always exciting.
Who said that?
Braden, of course.
Damn.
I said Disney is exciting just because that stock's been so beaten to absolute hell over the past 8-9 months. And they finally put up a decent print, and it seems like sentiment is changing on that name with the new old CEO. So that's a name I'm going to be watching pretty carefully over the next couple of weeks, couple of months.
You also see a flight toward stalwarts, right? If things get shaky with techs. Anybody else? Any names?
Yeah, I think Scoob has something to say.
Oh, I just DM'd him, called him a little bitch. That's all.
Damn. He does speak.
No, I don't have any names. I leave the individual stock picking up to you guys. You guys are much better at that than me. I just look at the order flow and yes, my specialty.
Well, it's 7:30, so thanks everybody for coming out again on a Thursday night. I hope you got your drink on if that's your thing, and look forward to seeing everybody tomorrow. And Stas, welcome. You're the newest misfit here, so good to have you. And you're a survivor.
Thank you. Really much appreciate y'all having me. Thank you so much, guys.